Imagine every piece of gold ever mined in human history, every wedding bangle, every royal crown, every gold coin, every necklace hidden inside a family cupboard, every gold bar locked inside a central bank vault. Now imagine melting all of it together. You might think it would fill a mountain, or a city, or at least a giant stadium. But no, all the gold ever mined in human history would fit into a cube only about 22 meters on each side. That's it, a small building-sized cube. And yet this small amount of metal has survived empires, wars, bank failures, inflation, currency collapses, and financial revolutions. From London to Istanbul, from Beijing to Delhi, from Dhaka to Karachi, from New York to Dubai, families kept doing the same strange thing. When they wanted safety, they bought gold. But why? Were our parents simply emotional? Were they trapped in old traditions? Or did they understand something about money that modern finance keeps forgetting? This video is not financial advice. This is not a video telling you to buy gold. This is the story of why gold became the financial backup plan of ordinary people, and why even governments and central banks still keep it locked inside vaults. In many homes, there is a small box nobody talks about too loudly. It may be hidden in a cupboard, wrapped in cloth, locked inside a drawer, sometimes kept by a mother, sometimes by a grandmother. Inside that box, there may be a ring, a chain, a pair of bangles, or one small piece of gold bought many years ago. To an outsider, it is just jewelry, but to the family, it is something else. It is savings. It is security. It is a wedding gift. It is emergency money. It is memory. Nobody calls it a portfolio. Nobody opens an app to check it every morning. But everyone knows one thing. If life becomes difficult, this object can help. And that is where the mystery begins. Because long before gold became family jewelry, gold sat at the center of the world's money itself. Today, most money is digital. Numbers on a screen, salary in a bank account, a payment notification, a mobile wallet balance. But for much of modern history, money was supposed to be connected to something physical: gold. Under the gold standard, countries fixed the value of their currencies to gold. A paper note was not supposed to be just paper. It was supposed to represent a claim on something real. That is why gold felt powerful. It was not only decoration. It was not only luxury. It was the metal behind the promise. By the early 1900s, many of the world's leading economies were connected to this system. Money, trade, exchange rates, and national confidence all stood on one idea: paper is trusted because gold stands behind it. But then came a force stronger than financial promises: war. In 1914, the First World War began, and suddenly, the old financial promise became difficult to keep. War is expensive. Governments need money for soldiers, weapons, ships, railways, factories, food, and survival. But the gold standard limited how freely governments could create money. So during the war, many governments suspended the convertibility of their currencies into gold. In simple words, the promise became weaker. People had believed money was tied to gold. But war showed something uncomfortable. When survival is at stake, governments can change the rules. This is one reason gold never fully left the public imagination, because even if paper money changes, gold still feels like gold. But after the war, governments wanted to rebuild the old trust. They tried to bring gold back, and that decision would create one of the biggest financial traps of the 20th century. After the war ended, countries wanted normal life back. They wanted stable money. They wanted international trade. They wanted confidence. So in the 1920s, many nations tried to rebuild the gold standard. It sounded responsible. Gold would discipline governments. Gold would restore trust. Gold would make currencies respectable again. Britain returned to gold in 1925. By 1929, most of the world's nations had returned in some form. But there was a problem. The world after World War I was not the same world as before World War I. Governments had huge debts. Banking systems were weaker. Workers and voters expected more from governments. And the old gold system, which looked strong, became unstable. The world tried to rebuild trust using gold, but instead, it was walking toward disaster. Then came 1931. Confidence in one of the world's most important currencies, the British pound sterling, collapsed. People wanted safety. Money moved. Gold reserves came under pressure. And in September 1931, the United Kingdom suspended the gold standard. Think about what that means. This was not a small country. This was not some unknown currency. This was Britain, once the center of global finance, and still the pressure became too much. For ordinary people around the world, events like this left a deep lesson. Banks can be respected, governments can be powerful, currencies can be famous. But when trust breaks, everything can move very quickly. Gold remained attractive because it felt different. A banknote is someone's promise. Gold is an object in your hand. Here is the twist. Gold as a family asset can feel safe. But forcing an entire economy to stay tied to gold during a crisis can become dangerous. Under a strict gold system, governments and central banks have less flexibility. If gold is leaving the country, they may raise interest rates, reduce money supply, and defend the currency, even if people are losing jobs and businesses are collapsing. During the Great Depression, this became a major problem. Countries that stayed on gold longer often suffered deeper and longer depressions. Countries that left gold earlier, like Britain and several Scandinavian countries, recovered earlier than countries that stayed committed to gold for longer. So the story is not simple. Gold, the object, was trusted. But gold, the rigid monetary system, could be painful. This is important because our parents were not running central banks. They were running households. Then, the story took another strange turn. During the Great Depression, the United States changed its relationship with gold. The government restricted the private use of monetary gold. Then, in 1934, the Gold Reserve Act transferred ownership of monetary gold in the United States to the U.S. Treasury. The official gold price was changed from the old level of $20.67 per ounce to $35 per ounce. This was not just a gold story. It was a trust story. People had believed gold and money followed fixed rules, but the Depression showed that in a crisis, even the rules around gold could be rewritten. And this is why gold has always had two faces. To governments, gold is policy. To central banks, gold is reserve. To families, gold is security. Same metal, different meaning. After the Second World War, the world wanted a new financial order. Nobody wanted to repeat the chaos of the 1930s. So in July 1944, delegates from 44 nations met at the Mount Washington Hotel in Bretton Woods, New Hampshire. They were not there to buy jewelry. They were there to rebuild the world economy. The result was a new monetary system. Countries would fix their currencies to the US dollar, and the US dollar would be fixed to gold at $35 per ounce. This was not the old gold standard exactly. It was a gold dollar system. Gold was no longer directly behind every ordinary person's banknote, but it was still behind the world's most important currency. Gold had moved from people's pockets to government vaults, but it was still there, quietly supporting trust. For a while, the new system seemed strong. The United States held enormous gold reserves. Europe and Japan were rebuilding. The world needed dollars. But the system had a hidden weakness. As global trade expanded, the world needed more and more dollars. But if all those dollars were supposed to be trusted because they could ultimately connect back to gold, one question became dangerous. Did America really have enough gold for all the dollars held around the world? By the 1960s, that question became harder to ignore. Foreign aid, military spending, investment, and balance of payments deficits pushed more dollars outside the United States, and eventually, there were more foreign-held dollars than the United States had gold to redeem at the official price. The promise became too heavy, and in 1971, the door to gold began to close. On August 15, 1971, President Richard Nixon announced a new economic policy. One part of that policy changed money forever. The United States suspended the dollar's convertibility into gold. This moment became known as the Nixon shock. It marked the beginning of the end of the Bretton Woods system. After that, the world moved deeper into the age of modern fiat money. Money backed not by gold, but by governments, central banks, law, and trust. And that is the key word, trust. Because once money was no longer tied to gold, the value of money depended even more on confidence in institutions. For modern economists, this created flexibility. For ordinary families, it created a quiet fear. If money is only a promise, what happens when the promise weakens? Now, let's jump closer to our own lives. If you look at gold over the last 30 years, the chart looks dramatic. In the 1990s, gold was still priced in the hundreds of dollars per ounce. By the 2020s, it had moved into the thousands. At first glance, it looks like a simple story. Gold went up. But that is not the full story. Gold did not rise in a straight line. There were boring years. There were painful drops. There were moments when people lost patience. There were years when other assets looked more exciting. Gold is not a machine that goes up every month. It sleeps, it scares people, it disappoints people. Then, during uncertainty, inflation fears, banking stress, wars, or currency worries, it can suddenly wake up. This is why our parents' gold habit was not really about trading. They were not trying to catch the perfect price. They were trying to keep something that would survive time. But here's the part economists often miss. Most families did not buy gold because they studied a chart. They bought gold because cash disappears. Think about it. Cash in your hand is easy to spend. Money in a bank account is easy to withdraw. Mobile wallet money is easy to transfer. Salary comes in and somehow it disappears into rent, groceries, transport, school fees, relatives, online orders, and emergencies. But a gold bangle is different. You don't sell it because there is a discount online. You don't sell it because you want snacks. You don't sell it because your friend called you for tea. Gold creates friction, and sometimes friction protects savings. This may be one of the biggest reasons families loved it. Gold protected them not only from inflation, but from their own spending habits. But now the story becomes dangerous, because when people say, "I bought gold," they may not have bought as much gold as they think. At a jewelry shop, you are not paying only for gold. You may also be paying for design, labor, wastage, stones, branding, taxes, and emotion. Imagine two people. Both spend the same amount. The first person buys a simple, heavy, plain gold bangle. The second person buys a fancy necklace with stones, complex design, high making charges, and brand premium. Both say, "I bought gold." But financially, they bought very different things. One person put more money into actual gold. The other put more money into beauty. Beauty is not bad. Jewelry is meant to be beautiful. But beauty and savings are not always the same thing, and this is where many families make expensive mistakes. This is why older gold buyers often asked boring questions. What is the weight? What is the purity? What is the making charge? Are there stones? Can I sell it later? Will I get a proper bill? These questions may sound simple, but they separate gold as decoration from gold as savings. If the goal is fashion, design matters more. If the goal is saving, the question changes. How much of my money actually became gold? A simple piece with lower labor cost and more gold content may behave more like savings than a complicated design with high making charges. And purity matters too. 24 karat is pure gold, but softer. 22 karat gold contains about 91.7% gold. 18 karat contains 75% gold. So the old rule was simple. When buying gold for savings, do not only look at shine. Look at what you are actually buying. Gold survived not only because it could be sold. Gold survived because it could be gifted. This is where finance becomes emotional. A mother gives her daughter bangles. A grandmother passes down a chain. A family gives gold at a wedding. A newborn receives a tiny bracelet. A couple exchanges rings. Gold appears at the most emotional moments of life. Birth, marriage, festivals, inheritance, migration, new beginnings. Cash can disappear. Clothes become old. Electronics lose value. But a gold gift can remain in the family for years. This is why comparing gold only with stocks or bank deposits misses something. A stock certificate does not sit in a wedding photo. A bank balance does not carry your grandmother's memory. Gold is one of the few assets that can be love, status, tradition, emergency money, and savings. Now we come to the fear behind many gold purchases: inflation. A father goes to the market. Last year, this amount of money bought rice, oil, eggs, vegetables, and fish. This year, the same money buys less. Nobody broke into his house. Nobody stole the notes from his pocket. But somehow his money became weaker. That is the invisible thief. And this is one reason people expect gold to protect them. Because paper money can be printed. Bank balances are numbers inside a system. But gold is scarce, physical, and globally recognized. Still, we must be honest. Gold is not a perfect inflation shield every month or every year. Sometimes inflation rises and gold does not immediately help. Sometimes gold rises before ordinary people even understand why. So gold is not a magic umbrella. It is more like a long-term shelter people trust when they fear money is weakening. By the 2000s, the world looked modern. Banking apps, global markets, credit cards, rating agencies, central banks, complex financial products. It felt like the old financial panics belonged to history. Then came 2008, a crisis that began in the U.S. housing market, spread through the global financial system. Banks suffered huge losses. Governments stepped in. Millions of people lost jobs, homes, and wealth. For many ordinary families, the lesson was not technical. They did not understand every mortgage-backed security or every balance sheet. They understood something simpler. Even modern banks can shake. And when people see banks shake, they remember old forms of safety: cash, land, family networks, and gold. This does not mean banks are useless. Banks are essential. But 2008 reminded the world that trust is not automatic. And here is the part that makes the story even more interesting. Gold is not only sitting inside family cupboards, it is also sitting inside central bank vaults. Our parents kept gold for family security. Central banks keep gold for national security, reserve diversification, crisis protection, and trust. Different scale, similar emotion. In recent years, central banks have been buying gold in large amounts. In 2024, central banks purchased more than 1,000 tons of gold. By market value, gold became the second largest global reserve asset after the US dollar. So while ordinary people are sometimes told gold is old-fashioned, the most powerful financial institutions in the world still hold it. Not because it is magical, but because gold does something few assets can do. It does not depend on another country's promise in the same way a foreign currency or bond does. It just sits there, silent, heavy, trusted. But we should not confuse central banks with families. A central bank buys gold for reserves. A family buys gold for weddings, emergencies, discipline, memory, and status. A central bank thinks about geopolitics. A family thinks about school fees, medical bills, marriage, migration, and uncertainty. A central bank worries about reserve diversification. A family worries about survival. But both are asking a similar question: what can we trust when the system becomes unstable? That is why gold keeps returning to the story. It appears when people fear inflation. It appears when banks shake. It appears when currencies weaken. It appears when families want a gift that can also become emergency money. Gold is not modern. Gold is older than modern finance, and that may be exactly why people still trust it. So, were our parents right? The answer is not simple, because the question is not, is gold good or bad? That is too basic. The real question is, what job is gold doing? Is it jewelry? Is it emergency money? Is it a wedding gift? Is it forced saving? Is it inflation protection? Is it family memory? Is it status? Or is it social pressure? Gold becomes dangerous when people think it is magic. Gold becomes useful when people understand its job. Banks are useful. Gold is useful, but they are useful in different ways. A bank helps you transact, receive salary, send money, and participate in modern life. Gold helps many people feel protected because it is physical, scarce, portable, and globally recognized. A bank balance is a number in a system. Gold is an object in your hand. Maybe our parents were not rejecting modern finance. Maybe they were building their own backup system. So, why did our parents trust gold more than banks? Not because gold is perfect. It is not. Gold does not pay interest. Gold does not pay dividends. Jewelry has making charges. Purity matters. Storage matters. Selling price may be lower than buying price. Gold prices can fall or stay flat for years, and social pressure can make families overspend. But gold survived because it is more than an investment. It is memory. It is discipline. It is a gift. It is emergency money. It is portable wealth. It is trust you can touch. Maybe our parents did not know portfolio theory, but they understood human behavior. Cash disappears easily. Gold makes people stop and think. And maybe that is the real story. Paper can change. Banks can shake. Governments can rewrite rules. But gold still feels real. This video was not financial advice. It was a story about money, history, culture, and trust. So tell me in the comments, in your family, what did people trust most? Gold, land, cash, banks, or something else?